Hey everyone, welcome back to your weekly market update. I'm the Stock Bro, and today we're diving into what moved the markets the past week. We've got some big news on tariffs, trade policies, and how they're shaking things up for investors like you and me. Don't worry if you're new to investing, I'll break it all down so it's easy to understand. Let's get started. Okay, let's talk about the big story this week, tariffs. If you're wondering what a tariff is, it's like a tax that a country puts on goods coming from other countries. Last week, President Trump signed an order slapping a 25% tariff on all cars and trucks not made in the US. That starts April 3rd for fully built vehicles, and by May 3rd it'll hit auto parts too. But why does this matter? Well, about half of the 16 million cars sold in the US last year were imported, so this could mean higher car prices for consumers. Imagine you're shopping for a new ride. Those extra costs might get passed on to you, and it's not just new cars. Used car prices, repairs, even insurance could creep up too. Now this news hit the stock market hard. Shares of car makers like those in Germany and South Korea took a dive. Germany's stock index, the DAX, has a lot more auto companies than our S&P 500, so they felt it more. Rental car companies though, their stocks actually jumped because their used car fleets might be worth more now. Funny how the same news can affect different companies in opposite ways, right? But wait, there's more. On April 2nd, just a few days from now, the US is expected to roll out something called reciprocal tariffs. That's a fancy way of saying, hey, if another country charges us a tax to sell there, we'll charge them the same to sell here. It's like a tit-for-tat trade rule. This could affect all kinds of products, not just cars. The government's hinted at targeting things like lumber or even pharmaceuticals. Some countries with low taxes on the US might get a pass, but others might face bigger hits. Here's the catch. No one knows exactly how this will play out. Other countries might fight back with their own tariffs, or they might try to negotiate. It's like a global chess game and we're all waiting to see the next move. So why should investors care? Well, markets love predictability, and right now there's a lot of uncertainty. There's even a thing called the Economic Policy Uncertainty Index, basically a measure of how confused everyone is about the economy. And to give you some context, it's at its highest since the pandemic started. When there's this much unknown, like how big these tariffs will get or how long they'll last, stock prices can bounce around a lot. We saw that this week. The Dow dropped 1%, the S&P 500 fell 1.5%, and the Nasdaq took a bigger hit at 2.6%. That's what we call a correction, a drop of 10% or more from a recent high. It's the first one in a year and a half. But here's the good news for beginners. Corrections happen. They don't mean the world's ending, they're just bumps in the road. Okay, let's not get too caught up in the drama. There's stuff we do know that can help us stay calm. Here are 5 things keeping the economy on track. Companies are still making money. Big US companies in the S&P 500 are expected to grow profits by over 10% this year. That's a sign the economy is not about to crash. Jobs are solid. Unemployment's low, and businesses are hiring more people than we need to keep up with population growth. The Federal Reserve's chill. The Fed sets interest rates, and they're not rushing to raise them. They might even cut rates twice this year, which could help the economy. Growth policies might be coming. The government's talking about tax cuts and less red tape for businesses. Stuff that could boost stocks. And lastly, no big warning signs. Things like high-yield bonds, basically loans to riskier companies, aren't flashing danger yet. So even with tariff chaos, the basics of the economy still look pretty good. Now, let's talk about you. If you're investing or thinking about starting, what should you do? First, don't panic. History shows that when the economy keeps growing, these dips can be chances to buy stocks on sale. That said, don't expect stocks to rocket back up overnight. With all this trade uncertainty, it might take a few months to settle down. My advice? Spread your money around. Mix US stocks with some international ones. Places like Europe or Asia have been doing better this year. Also think about value stocks. Companies that look cheap compared to their earnings, and sectors like healthcare or financials. Those aren't as tied to trade wars and might hold up better. And don't skip bonds. They're like a safety net when stocks get shaky. Okay, let's zoom out from the US for a minute and see how the rest of the world's handling this tariff news. It's not just the US's markets feeling the heat. In Europe, stocks took a hit too. The Stoxx Europe 600 index, which tracks big companies across the continent, dropped 1.4%. Germany's DAX fell 1.9%. No surprise since they're huge in the auto industry, and that 25% US auto tariff stings. France and Italy saw losses too. though the UK's FTSE 100 squeaked out a tiny gain of 0.1%. There's some hope though. Eurozone businesses are growing, and Germany's feeling better about its economy. Plus, a partial ceasefire between Russia and the Ukraine gave markets a little boost early in the week. But those tariffs, they're definitely souring the mood. In Japan, the Nikkei 225 fell 1.5%, and their broader Topix index dropped 1.7%. Why? Japanese car makers like Toyota and Honda export a ton to the US. Autos are a third of their exports to the US. Their prime minister called it a very big problem, and they're begging for an exemption. The yen weakened too, which means their money buys less against the dollar. That could delay their central bank raising interest rates, keeping borrowing cheap for now. China's markets were calmer. Their CSI 300 index barely moved up 0.01%, while the Shanghai Composite dipped 0.4%. They're more focused on their own economy. Industrial profits shrank slightly, and they're pushing hard to get people spending more. With US tariffs looming, China's aiming for a 5% growth this year, but that might need a big stimulus plan. Hong Kong's Hang Seng, though, fell 1.1%, showing a bit more worry. Mexico's feeling the pressure too. That 25% auto tariff hits them hard, since a huge chunk of their exports, 32%, are cars and parts headed to the US. Experts say it could act like a 5% tax on all of their exports. Their president's playing it cool, waiting to see what happens April 2nd before hitting backs with tariffs of their own. Before we wrap up, here's what to watch this week. We've got the ISM Manufacturing PMI, that's a report on how factories are doing, and the non-farm payrolls report, which tells us how many jobs were added. Both come out soon and could move the markets. I'll break them down for you in the next video. If you're new to investing, my big takeaway is this. Focus on the facts, not the headlines. Markets will wiggle, but the long game usually wins. To be fully caught up, watch last week's video on screen right now. And please let me know your opinion on the tariffs in the comments below. Thank you for watching till the end, and as always, happy investing.